welcome to The Trade. Before we get into the charts that matter, let's have a look at what traders are watching out there today. President Donald Trump tasking his economics team with devising plans for reciprocal tariffs on every country taxing US imports, ramping up prospects for a global trade war with American friends and foes. A group of state attorneys general suing to halt Elon Musk's efforts to slash federal spending as the head of President Trump's new government efficiency agency, escalating the legal fight over the billionaire's influence in the White House. Gold prices rising amidst all this uncertainty, heading towards $3,000. Oil prices, though, they were pretty much a little lower. This is on this potential peace deal between Russia and Ukraine. And New Zealand's central bank expected to follow through on plans to cut interest rates with another 50 basis point reduction on Wednesday, according to Reuters. We're also, of course, expecting a rate cut here in Australia. Well, the market has been seesawing around short-term headlines. Ilya Spivak from Tasty Live joining me now. And Ilya, you're saying that the underlying story suggests a larger macro realignment underway.
Indeed. Very good to be here as always, Juliet. Obviously, we've been staring at these headlines. Tariffs here, they're not here. First they're on Canada and Mexico, then within 24 hours they're not. Then we're going to get reciprocal tariffs. Now they're pushed back to April, maybe, while we figure out how all that works. And the markets are, of course, seesawing around all of this. Add into that the spice that the DeepSeek announcement was. And there's all kinds of things that pull the markets this way or that. But what we saw this week was a really interesting response to US CPI data that told a really interesting story about the larger forces at play. And of course, at first blush, what you saw, and I have a 30-year U.S. Treasury bond here chart for you to illustrate, what we saw was, needless to say, a hot number, especially for core inflation. The expectation was that it would go down from 3.2 to 3.1%. It actually went up to 3.3%. Not surprisingly, yields surged and bonds sold off, as you got this expectation that maybe the Fed would not have as much scope to cut rates. But stocks really didn't run away on this news, and neither did the US dollar. And of course, a day later, as we can see from charts here, the PPI numbers came out, and we've fully erased that bonds sell off and yields have come back in. So what was in this data? Well, first in CPI and in PPI with confirmation, but the CPI really the standout. The core services component, where all of the inflation lives, it actually cooled and gave us the lowest contribution to overall inflation since February of 2022. And what happened at the headline was mostly smoke and mirrors, with rebalancing and rebasing to less negative numbers on goods and a slight shift from negative to positive contribution on energy. When we look at what is actually happening to the underlying economy, and indeed the service sector, the most important part of that economy, it seems to be cooling. And that, of course, rhymes with the ISM and PMI numbers that we got last week. The S&P Global PMIs in particular are very dramatic. The slowest U.S. service sector growth in a year there. And seemingly the CPI numbers and today the PPI numbers underscore that there is some sort of a weakening that's happening under the surface to the overall economy, tariffs or no.
All right, what does all this mean in terms of the movement, Ilya, in the stock market? Because we did see some strong momentum overnight, Thursday, your time, but they didn't really react to the inflation data.
That's right. So yesterday, as we can see here, we get that hot inflation number. Stocks lurch lower for a bit, but then ultimately erase almost all of that. And it seems as though they looked under the surface. They saw that underlying service sector inflation, which is the only thing really that matters for the Fed. They certainly don't have any agency over global energy and food costs. That part of the story actually cooled and cooled significantly. And in that, this, of course, as we just said, rhymes with that weakening PMI numbers complex from S&P Global and ISM. The market's got the sense that maybe there's a growth concern that's brewing downwind here. And so ultimately, stocks end up going nowhere. We got a little bit of a pop today on that delay of reciprocal tariffs for a few months, but we're still in the same range, still under those highs that we set in early December. This, of course, makes for a very vulnerable environment because if once we get through all of the pomp and circumstance of guessing what the president says next or what may happen with this or that AI announcement, the underlying story may well be the U.S. economy itself is finally starting to lose its ability to outperform. And it's doing that at the same time that China remains weak and Europe is barely growing at all. So the global economy essentially has no safety net. If the U.S. service sector is in fact slowing, as this data suggests, then we could be looking at global recession risk 6 to 9 months out. And perhaps that's why stocks are reluctant to really make hay of any of this.
What does all that mean then for the euro, particularly as we await these tit-for-tat reciprocal tariffs and whether or not there's going to be an all-out potential trade war or conflict with Europe and the US?
Indeed, the euro is a great barometer of sort of the overall direction of the US dollar. And of course, you might have expected, you get a hot CPI number. The expectation from there, if you look at the bond market, certainly yesterday, is that the Fed cuts less and maybe later. That should be very supportive for the US dollar. But like stocks, they have a real short reaction function. So the dollar goes up a bit at first and then comes back in, so much so that the euro actually manages to finish yesterday with gains and continues to push higher today. That's not the kind of environment where you'd say, oh, higher inflation, higher interest rates, on top of this, maybe tariffs, maybe that's inflationary, maybe even higher rates. No, this is in contrast, telling us that the dollar is on weaker footing, which would be consistent with the market being concerned about the U.S. business cycle, and likewise with the idea that if the Fed is delaying rate cuts now, we, of course, heard a lot of neutral and vague dancing around from Jay Powell in his testimony this week, much as we did after the January FOMC announcement. If the Fed is delaying now, then what the market is perhaps surmising is they'll have to cut more later if the business cycle is in fact turning. So things are relatively anchored at the front end, but of course, the long end of the curve has given us low rates again. All of yesterday's rebound is now gone.
All right, Ilya, interesting stuff. Have a great weekend. Thanks so much, Ilya Spivak there from Tasty Live. That does it for this edition of The Trade. Be sure to join us again next week.